the call. My name is Bharat. I'm the CEO and founder of Appomate. And today we have Alex Solo from Sprintlaw, a special presentation on safe notes. It's something our clients and our community people have been asking about in terms of fundraising. How to use safe notes to safely raise funds. So I thought I'd invite Alex and do a session for our clients and for people in our community. So yeah, thank you, Alex, for your time.
Great to be here. Yeah. Awesome. So shall I kick off, Bharat?
Yeah, go ahead.
I'll take that as a yes. Let me just grab my screen share. 1 second. Everybody can see that okay?
Yeah.
Perfect. Well, thanks so much for joining. And as Bharat mentioned, I'm Alex. I am the co-founder of Sprintlaw, and we are going to be talking today about safe notes. Before we get into the kind of legal detail, just to give a little bit of an introduction as to who I am and what Sprintlaw does. We're an online law firm really designed for startups and small businesses. Unlike traditional lawyers, we don't charge by the hour. All the legal work we do is fixed fee, and we help smaller companies in all kinds of areas of law, from safe notes like we're talking about today, all the way through to intellectual property protection, contracts, setting up your business, employment law, data and privacy, and everything else. We also have an optional membership subscription, but the majority of our clients do sign up to this. It's a great way to sort of work with us on an ongoing basis as your lawyers, and you also get access to a ton of software tools, free basic legal documents, e-signatures, credits to use on legal services. We've got a new legal AI tool that you can speak to with your voice or text and ask any questions, and you get unlimited consultations with our legal team, which could be really useful if you just have quick questions for lawyers. We also, I guess to give a bit of a background to us, we are a startup ourselves. We've been around since 2017. We have raised, I think, 4 or 5 rounds of funding now. Some of them were safe notes, which we'll be talking about today. Some of them were equity rounds. So we kind of know what it's like to go from, myself and my co-founder working in an apartment bedroom all the way through to expanding to multiple countries and growing the client base and things like that. That's a bit about us. And then for anyone who's working with us through Appomate, we have actually got a really great partnership discount available. So I've got the link on screen. We can maybe also drop it in the chat. But if anyone wants to sign up to our membership and kind of start working with us, at any time, you can use that link to access this deal, which is about $400 off on our Sprintlaw membership. So let's talk about safe notes. And as I'm going through, do feel free. I'm just going to quickly pull up Teams next to me. Do feel free to drop questions into the chat. I like to take questions as we go through, because it's often better while we're talking about the subject matter to kind of answer the questions. But of course, if we get time, save some time at the end as well if anyone wants to ask anything else. But the table of contents is we'll be talking a little bit about different types of raises. We'll be going through the safe notes and the various terms, and we'll be talking about some other considerations as well when you're using safe notes. So let's just kick off with talking about different types of capital raises. And so safe notes, for those that don't know, are one way that a startup company can raise funds from investors. It's one of a few. On screen we have probably the 3 most common ways that we see startup companies raise funds from investors. There's the straight equity investment, which is what a lot of people would think is the most common way of raising investment, where a company will sell a percentage of its company to an investor for X dollars. And then that investor becomes a part owner or shareholder of the company and is hoping that they're going to get returns either through dividends, from the profits of the company, or often in startup investing, the company will be sold or listed on a stock exchange one day for large amounts of money, and the equity investors will get their returns. Then we have a type of investment called the convertible note. The convertible note was sort of historically known as a kind of a bridging financing option. So for companies that weren't quite ready to work out what percentage of the company they were going to give away, they weren't quite ready to do this straight equity round. What would often happen is the companies would take out a loan, but not necessarily with the intention of repaying it to the investors, but rather to say to the investors, look, it'd be great if you can give me a loan. I will keep a record of how much interest I owe you on that loan. But instead of repaying you, when we do our straight equity round in 1 year, 2 years time, and we've worked out what the company's worth and what percentage of it we're going to give away, I'll convert your loan into equity. And you'll get your initial investment plus some interest, and that will kind of turn into equity, and you'll get your shares. So this document called a convertible note has been used for many years and was a very common alternative to straight equity fundraising, and was previously used a lot in early investment stages, where, again, when you do the straight equity round, one of the big challenges for particularly startup companies is, as we have on screen, X dollars is invested, Y% of the company is given away. Well, that means you have to work out essentially what is the company worth, and if someone pays me $100,000, are they going to get 1%, 10%? Is the company worth $1 million, $10 million, $100 million? In the startup stages, we often don't know what the company's worth. And so the straight equity rounds could be difficult because the company may not be generating revenue yet. It may just be an idea. It may be a prototype product. So the convertible notes were popular for that purpose, as a way of delaying the question as to what the company's worth until a little bit later, but getting the founders the kind of funds early on. And then we have the safe note, and the safe note is really what many might call a modern version of the convertible note for startup investing. It's very similar to the convertible note. It serves the same purpose. The idea is that people can invest in the company without having to know what percentage that they're getting right now. But the key feature of the safe note is, rather than having it as kind of a loan with interest, instead we use the concept of a discount, which was in some convertible notes, but a discount which basically says, look, you will invest in the company now. I can't tell you what percentage you're going to get, but I will tell you you'll get an early bird discount when we eventually do our straight equity round later on, when we've worked out what the company's worth, when we're raising more investment. You'll get a discount on the price per share paid by the straight equity investors. So you could either invest 100K now on the safe note and get, say, 110K worth of value when we do our straight equity round, or you could wait and, if you want to invest later, you can put in 100K and you'll just get 100K worth of value. So, I mean, I like to think of the safe note as, the early bird discount concept. It's something you do with your early investors to say to them, we're not yet going to do our equity round, but we are going to give you a discount on the rate that will be paid by other investors coming in later. So that's the basic concept of a safe note. Now, there are other terms other than the discount, and there's a little more to it than just the early bird discount concept. But I think that's a good way of, at a high level, understanding what we're talking about when we're thinking about the safe note. Just to dive a bit deeper into kind of what I was kind of going through, SAFE, what does it stand for? It is, in fact, an acronym. It stands for Simple Agreement for Future Equity. And it is becoming very common in early stage startup fundraising. And I alluded on the earlier slide to many people would think that for at least for startup investing, straight equity is the most common form of fundraising. We've been around since 2017. When we first started, safes were pretty much unheard of in Australia. Since about 2019, they've become more and more common. And I would say as of 2024, probably a bit over half of the startup first round investments that we see happen are done using safe notes. So they are becoming pretty common. I don't know if anyone's done the numbers as to whether they are the most common in Australia, but they're probably not. But I would suggest that they're getting pretty close to being one of the most common ways of raising funding. As we discussed, you don't get the equity if you're an investor right away. You get it in the future. You're just getting that discount. One of the main reasons it's so popular is because it's super easy to understand what it is. There's very few terms. There's a standard document that exists in Australia that saves time on, what's the legal contract going to look like. Unlike a traditional equity round, when you're giving away a percentage of the company and you're taking on 10 investors in a traditional equity round, you actually have to synchronize everything so everybody gets their equity on the same day, because there's a big day where the round closes and you'll issue the shares to all of the people that invested. A lot of logistics involved in that. With a safe note, because you're not actually giving anyone any shares or ownership rights in your company, you can often sign them asynchronously. You can sign up one safe investor on the 1st of May, one on the 15th of May, one on the 22nd of May, one on the 3rd of June. And it can make it a lot logistically easier to actually close a safe round. Of course, it's common to not to spread them out too long. Otherwise, it can be seen as unfair to earlier safe investors who are getting no better early bird discount than late safe investors. But it is one of the advantages and flexibilities of using the safe note for early funding rounds. And for those interested in the history of this document and why it only emerged so recently, Y Combinator, who are probably the most famous startup accelerator in the world, Airbnb and a bunch of other really well-known tech companies came out of this accelerator, invented this document in 2013 as an alternative to the convertible note. Now, interestingly, the reason they invented it is very specific to US law. Under US law, convertible notes were problematic because they were seen as loans and not equity investments, even though they were there was no intention in most cases to repay the loan. And that attracted certain complicated tax treatment in the US. And so Y Combinator invented this safe note to achieve the goal of a convertible note without it being classed as a loan, hence the name Simple Agreement for Future Equity. The word loan appears nowhere in the document, and there's no clause in the document that requires any form of repayment, if that makes sense. So so that was why it was invented. In Australia, we never had that tax problem, so we never really needed the safe note. We could have just used the convertible notes. But because the document was so simple, because it was kind of being popularized with a lot of well-known tech companies, it started to become quite popular here. And then the AIC and Spark Helmore released an open source safe template. I think it was in 2018 or something like that. And when that document came out in Australia, that's when it really started being used instead of things like convertible notes. So that's the kind of history of this thing. Again, it is a new document, and there's a downside in that it doesn't have 50 years of legal precedent in terms of how it works and how it's going to be interpreted. Didn't come out yesterday. It has now been, I guess, 11 years since it was created. I will say that there have been some disputes that have emerged over, poorly drafted safe notes or challenges when the safes were converting into equity, where people have got the maths wrong and then investors have got less than they thought, and we're starting to see some of that come out. And Y Combinator made a pretty big update to their safe notes a few years ago, which I'll talk a little bit about at the end, which the AIC in Australia also updated their safe notes actually only about 9 or 10 months ago, to fix what many saw was a problem in the safe notes. So again, these documents are slightly less settled than the equity documents, and many more conservative investors either haven't heard of them or feel uncomfortable using them for that purpose. And many lawyers who don't work with startups have also not heard of them and may be uncomfortable working with them. So just something to be aware of when you're out there, if you decide to use safes to fundraise for your business. Let's talk about the terms in the safe note document. There's essentially 3 common terms and 1 occasional term that you'll see in a safe note. You've got the valuation cap, the discount, the conversion trigger, and the interest and maturity date. And I'll just go through each of these in turn. So we talked a little bit about the discounts, which I'll come to in a second, the early bird discount, but the valuation cap is actually one of the most important terms in a safe note document. And what the valuation cap is it sets a maximum valuation at which the note will convert to equity. And it protects early investors by allowing conversion to happen at a lower valuation if future rounds are higher. And it helps provide more upside potential for investors in high growth scenarios. So to explain how a valuation cap works, in a safe note, you'll have your safe note legal document. It's about 20 pages long. It explains how the whole document works, what happens in all the various different scenarios. And then at the back, it will have a little table with the variables that the startups fill in for their particular company. And so one will be the discount, which I'll talk about in a moment, but another will be the valuation cap. And the valuation cap is set at a fixed number, for example, $5 million. And so what this means is if the company raises a future round at, let's say, a $10 million valuation, the stakeholders convert into equity as if the valuation was 5 million, not 10 million. So what we're trying to work out here is this scenario where, okay, someone, let's say they're given a 10% discount on their safe note investment. That's the early bird discount is 10%. They invest in this early stage company. The company does really, really well before it even raises its equity round. It becomes very, very popular. It gets tons of users. It really goes viral, if you will. And a year and a half later, when it goes to raise its equity round, it now is able to attract a really high valuation of 10, 15, 20 million dollars. If I'm a safe holder, I'm feeling a little bit unhappy because all I'm getting is a 10% discount on this $10 million value of the company. But I really invested. I took the risk before the company really got very popular and sort of got this really high valuation. So it's a protection offered, this valuation cap, for the early stage investors. It says, look, you'll get your discount of 10% on the next round. But if the value goes above 5 mil, let's forget about the discount. We'll just cap you at 5 mil. You're going to convert at $5 million. So if the company ends up being worth 10, 20 mil, you're going to get a much bigger discount than 10%. You'll get a 50% discount actually. And so it's an attractive term for the investors to have this valuation cap. So commonly in the safe note, you're going to see the discount and you're going to see this valuation cap, which sets a maximum on the or a minimum equity rather on what the investor is going to get when they invest in the business. Now the valuation cap, in a way, is almost like a fallback value for the business. One of the things we mentioned earlier, an advantage of the safe note is that when you're doing these early rounds, you may not know what the company's worth, and one of the arguments for a safe note is to your early investors, look, I don't know what this company's worth. A safe note is better because we'll work out later on, once we've got a little more traction, maybe once a larger venture capital investor comes into the business, we'll work out what the company's worth then, and you'll just get a discount pegged to that price rather than me making up a price now. That's one of the advantages of the safe notes. But when you have the valuation cap, you are now putting a number value of the business in the document. And so many would argue that this is like a worst case scenario or best case scenario, depending on whether you're an investor or founder, of how much equity the investor is going to get. And an investor knows, once you tell them what the valuation cap is, they know the minimum equity they're going to get in the business, because they know I'm going to get at least, X% of 5 million. If they put in $1 million and the cap's 5 million, they're going to get 20% under their safe note. They might get more than that 20% if the company only raises at a $4 or $3 million valuation, but they know they're going to get at least that kind of 20%. So you can see why it's valuable for investors. But again, you often see arguments happen around the valuation cap when a safe note's being negotiated, because effectively we're trying to set a minimum value of a minimum number of shares and a maximum value of the business, which is in a sense what we're trying to avoid with safe notes. And so some safe notes actually don't have a valuation cap, they just have a discount, but it's quite common I would say in maybe 80+% of the safe notes that we see, there is still the valuation cap introduced for the investor protection. So that's the valuation cap. Let's talk about the discounts. We've already talked a little bit about how they work, but just to kind of be super clear about it, the discount provides a percentage discount on the price per share paid by investors at a future equity round. So as I said earlier, it's rewarding those early investors by allowing them to convert their investments at a lower price than new investors. So again, we have this scenario of you put in $100,000 under a safe note. You know, if there's a 10% discount, you're going to get around 110K worth of value or shares in the company at the future equity round, as compared to someone at the future equity round putting in 100,000 and only getting 100,000 of value. So it's that early bird benefit. In terms of what the common discounts we see in safe notes are, it ranges from 10 to 30%. You know, it's difficult to work out what it should be, but one way to think about it is, you know, this cash the investor's putting in your business, they could also invest it in other sources and get if it's the bank, 5% returns. If it's somewhere else, 7, 10, 12% returns. If you're going to not raise your next funding round for 4 years' time and you give them a 10% discount, their early bird discount doesn't look so good because they could have put the money elsewhere and then come back later. If you're going to raise very soon, then a 10% discount looks pretty good because where else are they going to get 10% return on their money? So that's one way to think about it. It's not quite that simple because a lot of times people invest in safe notes just for the opportunity to get into a business. You know, oftentimes in a safe round, startups will go out to individual angel investors, friends and family, and raise small amounts of money under the safe notes. And then when they do their larger equity round a year or two later, they have one big fund who's going to do the whole round, and there's actually no opportunity for other smaller investors to even join. So, you know, it isn't, I think, right to just think of it in as similar to an interest rate, because it's also an opportunity. But again, that's at least one way to peg the value. So if you aren't going to be doing your priced round for several years, you might give a higher discount rate. Or if you want to make the document more attractive, you might do a higher discount rate. It just depends on kind of what you can negotiate and what you can do. But 10 to 30% is what we see. I would say 10 to 20% is probably most of the safe notes. I didn't really talk about what's common with valuation caps. This is highly dependent on the business and, you know, where they're at and whether they're very, very early stage or they're kind of well established. But pretty commonly for, you know, pre-seed product only startups, what we see, and Cake Equity, who are like a startup platform in Australia, has a really good guide and benchmarks for, you know, what they're seeing. They got probably more data than we've seen on what's normal in terms of discounts and valuation caps. But just in terms of what we've seen at Sprintlaw, I would say sort of 3 to 5 million is the common pre-seed valuation cap for tech companies, for sort of SaaS businesses. And we see kind of 15% on average discounts. For popular companies, it's 10. And for ones that are really wanting to make the note persuasive, it's 20%. I mean, for Sprintlaw's very first funding round, we did do a safe note. And I'll talk a little bit about that as we go through the different terms. But we did I think a 5 million. Sorry, I think we did a 10 million cap, which was probably too good for where the business was at the time. And we did a 10% discount. So again, that's a benchmark for what one would do. Now, we weren't pre-seed at that time. We had revenue, we had customers. So if you don't have revenue or customers, you know, you might be closer to the 3 or 5 range, and you might have a bigger discount. But at least that gives you a little sense of how people do this in practice. So again, to explain how the discount works, you know, we got this example here. A safe note includes a 20% discount. In the next equity round, new investors pay $1 per share, but those safe holders get to convert their notes at 80 cents per share, given their discount, which gives them an advantage for supporting the company early. So they get more bang for their buck, if that makes sense. So we've talked about valuation caps and discounts. So let's talk about the conversion trigger. At what point do these safe note documents actually turn into real hard shares? What is the trigger event? There's a definition in the safe notes, which lawyers change from time to time. But typically, it's what we call a qualifying financing event or a qualifying equity round. And it's triggered when the company raises a certain amount of funding. So it'll usually say in the safe note document, this safe note entitles you to a 10% discount and a $5 million valuation cap, and will automatically convert to equity on those terms when the company raises a financing round of over $1 million or over $2 million for the issue of equity capital. This is an important term because, of course, dodgy founders could attempt to get a friend to invest 50K into the business and call that an equity round, and convert all their safe investors on a 10% discount of that investment. So we need to have some threshold of what is the real trigger event, what is the real funding round, and usually there's just a hard dollar figure put into the safe note, and it will say that's. When that happens, when we raise an equity round of above X dollars, you will all convert your safe notes into equity. So that's how the trigger works. Now, what happens if the company never raises a funding round? What happens if it's acquired? What happens if it goes insolvent? What happens if it lists on the stock exchange? What happens if it's sold? All these sorts of things. What happens in terms of triggering the funding round? Well, the safe note covers a lot of those scenarios. In many of them, if there's no qualifying financing event and the company winds up for some reason, the safe investors will get their money back plus the discount almost as an interest rate. So again, you put in 100K on a safe note, the company is acquired before you convert, you might get back 110K. So it's not a great note, not a great outcome necessarily for the safe holder, but they're not necessarily losing their money either. Similarly, if the company goes insolvent, the safe holder is treated like a debtor. And so to the extent there's any money left in the business, they say, I'm owed $100,000. And to the extent that could be paid out, they'll get the full 100 back, or if there's not enough, some percentage of that will be repaid to them. If the company never raises funding, I'll actually talk about that on one of the next slides, because that's a kind of different scenario. But in those different cases where the company doesn't succeed, that's kind of how it works. And so we got that example on screen, which I kind of already ran through. A startup raises $3 million in a Series A round, which triggers the safe note, and that event converts the safes into equity based on either the cap or the discount applied to the share price during the Series A round. So hopefully that makes sense in terms of the conversion trigger. Now let's talk about interest rates and maturity dates. And so this is really the time factor that I was alluding to a moment ago. So what happens, you raise these safe notes, it's an early bird ticket to the future equity show. But what happens if the show never happens, or the show takes 3 years to happen and people are just left sitting on these safe notes? The answer in the templates for Y Combinator and also the AIC is nothing happens, which is not very good for the investors. In general, safes do not accrue interest. In that way, they're different to those convertible notes I mentioned earlier. And they don't have a maturity date or a date which, if nothing happens, X, Y, Z, that clause is not included in the safe notes. And really, a lot of the time, certainly in the US, when people invest in safe notes, there's a leap of faith that the company will raise equity investment at some point soon. And it's not seen as a massive risk, the fact that if they don't, these people are sitting on safe notes, because it's known that for tech companies, they're going to be burning a lot of cash, and either they're going to die or they're going to raise an equity funding round. It's kind of known. So that's why people are often comfortable with the risk. In Australia, savvy investors are less comfortable. And we have seen scenarios where a lot of people raise safes, become profitable, and never raise an equity funding round. And that's not great for the safe holders because they're just sitting on these early bird tickets to an equity show, which never happened. And all they're going to get is, if the company's acquired or whatever it is, just their discount as a return. So it's not a great scenario. And so we do see some safe notes get modified to introduce a scaling discount and or a fixed maturity date. This, I should be clear, is in the minority of safe notes. We don't see this in most safe notes. Certainly, if I was an investor, I would want this. And for, I think, all but one of the Sprintlaw safe notes that we've done, we have included this in part because some of our investors are law firm partners, and so they were savvy enough to ask for it. But for a lot of our clients, as it's not in the template, it's not used that often. But you can include it. And so there's two concepts here. One's the kind of scaling discount, which is like an interest rate, and the second is a maturity date. And so the scaling discount basically says, all right, early stage investor, we'll give you a 20% discount on your safe note. But if we take more than 2 years to actually raise the equity round, that discount will increase to 30%. And if we take more than 3 years, that'll go to 40%. And so this gives a incentive for the company to hurry up and get that equity round going. Otherwise, they're going to be giving away a lot more of the company to these investors. And this increases the return of the investors each year that passes. So it gives them some benefit. And on top of that, you can also have a maturity date. So again, to use the example, you could say if nothing's happened by 48 months, the 4-year mark, for example, the safes are automatically going to convert into shares at X. And again, X can be the valuation cap. So if the valuation cap was $5 million, you could say, all right, you invest in my business under a safe note, 20% discount, 5 mil cap. If I take more than 2 years, that becomes 30%. If I take more than 3 years, that becomes 40%. And if I hit 4 years, I'm just going to give you your straight shares at $5 million. And so again, this is going to give the investor a lot more security because they know they're going to get a discount. That discount's going to increase over time. And if nothing happens and the company keeps going, they're at least going to get their share certificates and some cold hard rights in the business. Anyway, I think these clauses make a lot of sense, but because they're not in the templates, for whatever reason, they're actually rather uncommon. And a lot of the safe notes are kind of, open-ended and can go on indefinitely in theory. So we've covered a lot of the kind of hard terms in the safe note. Just some other things to be aware of with safe investments. First thing, safe investors don't have any rights in the business in terms of voting until their safe investment converts into equity. So this is, again, one of the risks for safe investors. Once you become a shareholder, when you do a straight equity round, you're a part owner of the business, and you may have a say, depending on the terms of the shareholders agreement, in the direction of the company. If the company wants to raise another funding round, they might need to offer you an option to invest. If the company is thinking of changing direction, they might have to take a vote. Depending on your percentage, you do have these hard protectable rights as a equity holder. While you're a safe investor, all you've signed is a 20-page document. You don't have any sort of property rights in the company. And so it is risky in a sense for the safe investors, until they become shareholders. So again, can be beneficial for the company because if you want to take on these early investors and make sure they don't have any control over the business, but you just need the funds for now, that's an advantage of the safe. But again, for investors, some raise the question about that and how that works. The second is the shareholders agreement. Now, oftentimes when you raise money in an investment, you are taking on new people to be involved in the business. And there's a document called a shareholders agreement, which is signed by all of the people that own a percentage of the company. And it sets out things like, what can the majority, usually founder shareholders, do without anyone's permission? What can the minority shareholders have a say in? What happens if someone leaves? What happens if there's a dispute between shareholders? What happens if someone wants to acquire the company and it's a really bad price? Do we have to accept it? Can we not accept it? What happens if the founders sell their shares to some other people? Can we, the investors, be left behind with these other people, or can we ask to follow along with them? All these different scenarios that can happen in a co-ownership of a business is covered in the shareholders agreement, and it's an important way that different shareholders' rights are protected. And again, these safe investors, they typically have not signed a shareholders agreement yet because they don't own shares. So similar to the first point, they have very limited rights, but not only do they have very limited rights, they're going to be converted to become shareholders at this trigger event. And oftentimes they're going to be asked at that point to sign a shareholders agreement, which they won't really have much of a say in, because it will typically be negotiated by the founders and the incoming equity investors, if it's a venture capital firm, for example. So it's a little risky in that sense for the safe holders. They don't really know what rights they're going to have in the company as well. They begin with no rights. They know they're going to get rights later, but they don't know exactly what those rights are. And so it is something to be aware of. And some, again, savvy safe holders will ask for a copy of the shareholders agreement or an example shareholders agreement, so at least they know what rights they're going to get in future. But of course, the company can never really promise that that won't be renegotiated at the incoming equity round. So it is a bit of another leap of faith for the safe holders, not knowing exactly what their shareholding rights will be. Now, as a kind of workaround, the safe note includes a clause, which is the third bullet point on screen now, that says, the safe holders will receive shares on no less favorable terms than the incoming equity investors. So the safe holders actually get the same rights as, by default, the incoming equity investors at the future funding round. So again, if you go out and raise a safe round from 5 angel investors, they sign the safe note, you haven't really talked about what sale or rights they'll get. And then a year later, you go out to a venture capital firm, you raise $1 million from them. The venture capital firm says, we want, we'll give you $1 million. We want all these special rights. We want anti-dilution rights. We want a say in big decisions. We want, if your company doesn't sell at a great value, we want to get at least our money back. They negotiate all these terms. The safe holders are entitled to all those same favorable terms that the venture capital firm has asked for. So that's, again, the default position. The safe holders benefit. And again, that is kind of to compensate for the risk of 1 and 2, is that the safe holders can rest easy knowing that potentially some sophisticated venture capital firm is going to negotiate for them, and they can piggyback off those rights. So that's kind of how the power dynamics work, if you will, with safe investors. Onto liquidity. So one thing that I guess is kind of clear from how I've been talking about the safe investment, but sometimes you find safe investors not fully understanding this. They've put in the money into the business, but it's not a loan. It's a deposit for future equity. And once they've invested, it's like any other startup share investment. It's very illiquid. The investor can't ask for their money back. It doesn't have to be repaid by the company. It's basically sitting there, on the balance sheet of the company, waiting to turn into equity. And when it turns into equity, they also can't touch it. They're just playing the waiting game until the company either starts being profitable and issues dividends, or more commonly with startups, is one day acquired. So, for safe investors, I think you should make them aware that, like any other startup investment, it's going to be illiquid, and you can't promise. You can tell them, I'm intending to run this thing for 3 to 5 years and sell it to some acquirer, but it might take longer. So you may not see your money back ever if we fail, or at minimum until we have an event where we sell the company. Or if you're profitable, of course, you can issue them dividends. But again, that's fairly uncommon for tech startup companies. So that's the point on liquidity. And finally, this is more of a tax point, but safe holders in Australia specifically may face less favorable CGT treatment. So people may or may not be aware, when you invest in shares in Australia, if you hold them from over a year, you get a 50% CGT discount when the shares are sold. For safe holders, you're not actually a shareholder until the safe note converts into equity. So the clock only starts ticking after you convert, versus in a straight equity investment, the CGT clock starts ticking the second that you invest. I mean, in practice, often these companies aren't going to convert for, aren't going to become liquid or return on investment for years. So this CGT thing may not matter because more than a year may pass after the safe holders convert to equity. But we have seen some scenarios where safe holders invested, the company was very quickly acquired thereafter, and the safe holders ended up in a less favorable CGT position than they would have if they'd invested in equity. So just something for really safe investors to be aware of. It's just a tax thing, but we have seen some questions about that, so I thought it was worth raising. So the final kind of legal point I want to talk about is this concept of post versus pre-money safes. And so this is a kind of change that happened to the safe note, and I alluded to this at the beginning of the presentation, back in I think it was 2021 in the US, but only November 2023. So yeah, about 11 months ago in Australia, the safe note standard document changed in the way that it works, to move from a pre-money safe to a post-money safe, which I'll explain what that change is in a moment. And the pre-money safes, high level, were typically better for the safe investors and the founders, and the post-money safes are kind of the opposite of that. So we've talked a lot about, as I've been doing the kind of example maths, this concept of the valuation cap, and then this concept of a triggering event where money comes into the business. When we zoom into the detail, there can be a significant difference in terms of how the valuation cap is actually calculated. So when we say, this safe note has a valuation cap of $5 million, a question arises as to whether we're saying it's $5 million before the new money's come in or $5 million after the new money's come in. So if someone puts in $1 million into the business, is it still a $5 million valuation after the $1 million comes in, or is it now a $6 million business because it was a $5 million valuation cap plus another millions come in? So that difference in maths actually can lead to a significant difference in the percentage ownership for safe investors. And over time, Y Combinator was seeing kind of unfavorable outcomes happen to kind of later incoming investors who were having to be more significantly diluted from the earlier investors because of the way the pre-money safe worked. And so the standard has now become the post-money safe. And so to explain the difference, we have the example on the bottom. If a startup does a pre-money safe with a $5 million valuation cap, if the company raises $1 million in a new round, the valuation is still considered $5 million for the safe holders conversion, which benefits that early investor with a larger ownership stake, because they're getting a percentage of 5 million, which includes that 1 million in the bank account. On the other hand, with the post-money safe at the save 5 million cap, after the company's raised $1 million, the investor's safe converts based on the total valuation, 5 million plus 1, which becomes 6 million. And so that early investor is getting a percentage of 6 million rather than a percentage of 5 million, which means they're going to get a smaller equity percentage. So it's a question worth asking, which note are you using? Because this change happened so recently in Australia, there's a lot of pre-money safes floating around that are waiting to convert. A lot of law firms are still using pre-money safes, but the templates are now post-money safes. I wouldn't say post-money has become, in practice, the Australian standard, even though the AIC have tried to make it the standard, and we still have done pre-money safe rounds in the last 3 and 4 months as well. So it's a bit of a transition time, but again, the I think where the world's going is that the post-money safes are going to be the way that safes are done in future. And even though it seems like a technical detail, you can see in the example, it can lead to quite a different percentage split depending on how the maths is done. So that was all of the content that I had. I'm very happy to take questions of any kind. We've got, I think, 10, 15 minutes left. I do have more content if there's no questions to talk a little bit about preparing for investment. But yeah, does anyone have any questions they want to ask?
If you don't mind if I just step in just for a quick minute, Breath's internet connection kind of dropped out when he was trying to do a bit of an intro. So he gave me a quick buzz to see if I could just let people know who we are. So Appamate are in partnership with Sprintlaw. We're here as an end-to-end solution for anyone who's looking from a technical startup point of view as well. We're there to help you in any sort of the phase. So when we're talking about from early ideas to validation or to even product launch, we're there to be able to support you. And as part of our ecosystem, the reason why we have partnered up with Sprintlaw is we just know how important this is, right? As part of your journey, it is one side of the business cube, I guess you could say, of what's important to be able to get things underway. So I just wanted to share that's who we are and what we do. So yeah, if there's anything that you need from us, please give us a call and we can help out. But I'll leave it up to questions for everyone else. So thank you, Alex. I appreciate it.
Thanks, Dan. And yeah, just a reminder for everyone, we do have this partnership with Appamate. So to the extent that you want to access discounted membership, you are welcome to. But yes, does anyone have any questions? Doesn't matter how simple or complex they are on safe notes, capital raising. Feel free to just jump in and ask by voice or text, whatever you like. All good.
Must mean your content's pretty good, mate.
Yeah, pretty comprehensive presentation. Oh, good. Well, given that we have a few minutes left, I might just cover a couple of extra slides if people are interested, which I wanted to cover. We've talked a lot about safe notes, but one of the big pieces of getting investment ready, if you're thinking of going out there and raising capital, is making sure that not only that you've got the advice around the safe notes and the safe note documents ready, but you actually got your business set up for investment. So we have on this slide something I'd recommend anyone who's thinking of raising funding think about doing, which is structuring your company to be investment ready. So the first thing to say is, at minimum, anyone who's raising investment kind of needs to be a company structure. We have these other structures in Australia, sole traders, partnerships. People may have heard of them. They're fine, for small scale businesses that are out there, trying to kind of earn personal income. But if you're running a serious business that's going to be splitting a stake between yourself and founders and other business partners, you really want to have a company. A company is like a separate legal person from you as an individual. It can have its own bank account. It can sign contracts. It has people called directors who are kind of like the mind and the arms of the fictional legal person, and it's got shareholders who are kind of like the body of the fictional legal person. But it's really quite separate from the owners. And when you have a company, you as an individual, if something goes wrong in the business, your assets are generally protected. People can't come after your house, your home, your car, your electric guitar, whatever other assets you might own. So it's important, particularly when you're getting funding involved, to have that separation between you as a person or a founder and the company, which kind of runs the business. So that's a minimum to kind of set up the company. Now, if you're planning on building a real big scaling technology company, you may not want to stop with just a single company structure. In the middle, we have one of the most common startup structures, which we call the dual company structure. And you have a holding company and an operating company. And so a holding company is a kind of an entity which you'll set up. It's the entity that's owned by the founders, the investors, anyone else who's got a stake in the business. It then has 100% stake in another company called the operating company. So it's like a subsidiary. People would have heard that term. And the operating company is the one that goes out and does business. It will, employ staff. It will sign contracts with customers. It will do risky things. And the idea is that the operating company might get into trouble. You might make a mistake while you're a startup. It might get sued by one customer or a supplier, or an employee might come after the business for whatever reason. If that happens, a lot of the value of the business, the intellectual property, say in the software that you've created, and the cash, if you've got tons of money raised from investors, a lot of that will often be put in this holding company, which is like a safety deposit box. And because of this concept of limited liability that I touched on earlier, the companies are fictional legal people. They can be liable, but it doesn't mean the people that own them are liable. Same goes for the operating company. It might be liable, but all of the precious assets are quite protected. So it can be very good idea if you're going to be raising funding to do this, just to make sure the cash is protected. Also, the IP is protected. And if something goes wrong in the operating company, it can be shut down. Another one could be spun up, and the company can kind of continue operating without having to necessarily shut down because of one bad decision that might have been made. Also, if you're expanding internationally over time, having this 2-layer structure makes it a lot easier. So, for example, at Sprintlaw, we have Sprintlaw Group Pty Ltd. That's our holding company, and then we have Sprintlaw Australia Pty Ltd, or actually, I think it's just called Sprintlaw Pty Ltd. But then we have Sprintlaw UK Limited, another subsidiary for our UK business. We're setting up one in New Zealand. We have something called Sprintlaw Tech, which holds some of our software stuff. Each of these entities have silos of risk. So if something goes wrong in the UK, it doesn't affect our Australian business, and it doesn't affect our holding company. If something goes wrong in Australia, it doesn't affect the UK, and so on. So having that 2-layer structure is not only good from protecting your assets, but actually good if you want to expand internationally. And I bring it up in the context of the safe notes because a lot of times people will be running their companies kind of this way, but the trigger point for the restructure is your first investment round. If you're going to be giving shares in your company, you probably want to be giving it in a holding company. Even if you're signing safe notes, the contract is usually between the holding company and the investors. And so it's a good idea to just get that split set up kind of early on. And we have on the right an even more sophisticated version of the company structure. So we've got the same dual company down the bottom. Up the top, you can see there's founders using trust to hold their shares. And that's something people may have heard of. But again, this is quite common for startup companies. One of the advantages of the company structure I talked about is this limited liability protection, where each founder has protection from the end employees and customers. But you can see in these diagrams, if there's a dispute between the founders themselves, they're both personally owners, so they can actually sue each other in their personal capacity, and potentially their houses and homes and electric guitars or whatever else they own can be on the line. If the founders are having a dispute. So oftentimes founders will set up these trusts, which you can see as an extra little shield from other shareholders, and it's a company that they control that holds their shares. In addition to the legal protection, the reason we use this type of structure called a trust is because it also has certain tax benefits. And again, if the company is sold in the future and the cash flows out of the business into a trust, it can be quite beneficial for the founders, rather than if they hold their shares personally. So this is probably the gold standard startup structure. The trusts don't necessarily have to be ready at the time of the safe investment, although it is a good idea to just do them early, or there can be tax costs of changing later. But yeah, again, if you're trying to get investment ready, this is quite common. And again, in the case of Sprintlaw, we began as a single company structure. We operated bootstrapped for I think a year, and then we raised our first funding round as a safe round. And just prior to that, we migrated everything to this structure on the right. So that's kind of an example of how it might play out in practice for your business. And then just finally, and we won't go into all of this in detail because I think we're coming up to time, but raising investment is a good time to just get a lot of your other legal items in order. So obviously we talked about setting up the business. Just make sure that I guess you've got your intellectual property locked down. Have you registered your brand name, your name? Have you made sure that everyone that's worked on your business has signed documents confirming that you own their intellectual property? Are you complying with regulations? Have you got contracts set up with customers and employees and so on? Getting your general legal stuff in order is a good idea. The last thing you want to do is, be speaking to a smart investor who starts asking you about the risks in your business, and you say everything's fine, but it's not, and you have some issue. or B, you've raised funding and you end up having to defend or rebrand or change your business name or have some issue in the business that emerges, which would not only be embarrassing to investors but may actually tank your business. So and we've seen a few too many of those scenarios for my liking. So it is somewhat my personal mission to tell people to at least do a bit of a legal health check prior to investment, because the stakes become a lot higher once the money's in. So yeah, that was just a little bit of extra content I wanted to share. We do still have a couple of minutes, but unless anyone has any questions, we may wrap up. Awesome. Okay, well, thanks so much, everyone. All the best with all of your businesses. And yeah, Zane, anything you wanted to add? Or
No, I just wanted to say that was really comprehensive, and I really appreciate you taking the time to go through that. It's always a nice little refresher for us as well. So I think it's really important that our founders know all of this. So yeah, really appreciate you taking the time, mate.
no worries. Thanks so much,
Appreciate
everyone.
it.
Yeah, we'll see you later.
Cheers. Thanks, everyone.
That's it.